Hi, everyone. This is Jason Bjerk of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. We had this returning guest on a little under 6 weeks ago, maybe 6 weeks, and we didn't get a chance to discuss all the different gold mining analysis that he has, and he has an extensive amount of it over on his website, goldstockdata.com. The gold and silver prices continue to rally, so it's a good time to bring him back on and talk more about the gold and silver mining industry, profit margins, some of the acquisitions that have happened in the last 6 to 8 weeks since we last recorded our interview. Don Durrett, thank you for joining me again.
Hey, Jason. Thanks for having me back. We had a nice talk last time. Let's do it again.
Exactly. And there's been quite a few deals in the last 6 to 8 weeks. So we had the Goldfields acquisition of Osisko Gold, of Osisko Mining, not Osisko Gold Royalty. There's two Osiskos. There's a spinoff. One of them was the royalty spinoff. And then you have Anglo Gold Ashanti buying the low cost gold mine in Egypt. But there's been some other deals lately too. Before we start talking about that, Don, let's just, for listeners out there, we're recording this interview on Thursday, October 24th, 2024. The gold prices continue to stay relatively robust at $2,733. The silver price is well above $33 at $33.61. I want to get your thoughts on Newmont's earnings release this week. Were you surprised at some of the numbers that came out from Newmont?
Oh, absolutely surprised. Yeah, their cost went up last quarter. Their ASIC went up last quarter. I don't think it went up $100 last quarter, but I think maybe 75. And then it went up 100 this quarter. I didn't see that coming at all. So their ASIC now is up over 1,600. I think it was 1,610. So that means their break even is about 1,950. Their margin is still good, but the story here is their cost jumping so significantly 2 quarters in a row. If you do a year on year on that, going up 100, let's say it goes up $80 a quarter, that's $320 in 1 year. That's totally unsustainable. I think that's the reason why it dropped 15%. It was at $58 yesterday. That was down to 49, so it dropped $9, almost 16% in 2 days. I think about almost 15% today.
And they
So
still have some pretty good margins, but I guess people are worried about the cost creep, how it continues to go up. It seems like every quarter or two, their costs continue to rise. I was worried about this when they announced the Newcrest Mining acquisition back then. I was trolled very heavily, mostly by Australian gold bugs who thought the acquisition was pretty good. And I was warning that Newmont was adding really high capex, not super high grade, not super low cost mines. And Newmont was telling the market, Don, that, oh, no big deal. We're just going to sell these high cost mines off and we're going to cash and monetize it and we're going to buy back shares and we're going to fix our costs. They're still telling people in their investors presentation, Don, that by 2028, they're going to have costs down to like $1,100 or $1,200 an ounce.
yeah. So they still have some tier two assets to sell. So and they are, like you said, they are giving guidance of cost to come down. But even at these high costs, as long as gold doesn't crash, if gold continues to trend higher, they're actually pretty cheap if gold trends higher. So I have them today at a 10 multiple, generating $5.5 billion at $2,700 gold. So their market cap right now is 57 billion, and their free cash flow, I have them right now running at a 5.7 billion rate. So they're generating a lot of cash, but they got beat up today because, like I said, 2 quarters in a row. And what you just mentioned, this could keep going, this could continue. The cost
Let's
keep
hope not. Yeah, it'll be bad for the whole. If Newmont is going to have this bad a cost increase, right? The whole
right,
industry, people are going to be like, I don't trust any of these gold miners now.
right. But I'm seeing a lot of companies that are maintaining their costs this year. Companies like Lundin, Orla, Alamos. There's a lot of companies out there that are maintaining low cost. So it's definitely not across the board. This is really interesting. So you have Barrick, which has had cost pressures, and you have Newmont, the two big dogs, right? And they're pulling down the ETF. So this is becoming a stock picker market. I think that buying GDX is not a way to go when you got Newmont at 14% of GDX. That's not a way to go anymore. You have to be a stock picker. But I think one of the stories coming out of this is that I think the quality majors are going to benefit, like Agnico Eagle, Kinross, Alamos. I think those three companies are going to benefit. Goldfields, maybe. Anglo Gold Ashanti, maybe. Lundin for sure. But some of these better quality names are going to benefit. And so instead of all the money going into Newmont and Barrick, people are going to go, I don't want those guys. I'm going to take the better names. So I think that's a big story here today, is that this is becoming a stock picker market.
And Lundin Gold, you're talking about Lundin Gold, right? So they only have one mine, but it's an amazing mine. It just happens to be in Ecuador. So it's Fruta del Norte, and then they keep having exploration upside successes and mill expansions. I mean, all the good things that you want from a mining company, they're achieving that with reinvesting their free cash flow. I think they probably need to go do an acquisition in the next 6, 12, 18 months, maybe get an asset outside of Ecuador. So hopefully they'll have some additional diversification.
Yeah, the thing about these big majors is a lot of people own them for the dividends. And as their balance sheets improve, the dividends are going to go up. Like Agnico, I mean, um, yeah, Agnico Eagle, they're actually have a really nice dividend, and I think it's going to go higher. So it's about 40 cents a quarter right now, $1.60. I think it's going to go to, $253 fairly soon. That's a
Have
lot of
any of
money.
the have any of the other mid-tier gold miners, have we seen any sizable dividend increases yet from some of the producing gold miners?
No, no, not in the big names like Barrick and Newmont and Agnico. They're not, really big dividends. But B2 Gold, some of the smaller ones, there's some in Australia, I mean, Africa. That's the only way they can get people to buy their stocks. So they have high dividends. But B2 is really interesting. I mean, they're 5% plus dividend, and they're undervalued. So
Well, they're
some,
mid-tier. They're
some
mid-tier, right?
yeah, some of the better dividend stocks are mid tiers. Interestingly, you have to look and see, but most of the big ones, even Alamos, Agnico Eagle, they don't have real high dividends yet. 2%, 2.5% is about as high as you're going to get. But I think they're going to go higher. And now we got $2,700 gold, and they're sitting on really good balance sheets, so they're going to expand their dividends up. I think there's going to be a huge demand for Agnico Eagle if they have a couple good quarters in a row here, and they start adding to their dividend. If they go from 40 cents to 50 cents, I think they will. I think next quarter, I think they'll go from 40 cents to 50 cents a quarter. $2 a share dividend is not bad.
So for B2 Gold, their valuation is down a lot. Normally, their valuation before they started to try to bring this new mine online in the Yukon territory, they had a pretty high valuation because they were a low-cost miner with their other mines in Asia. It seems that the market is worried about bringing this new mine, in the Yukon territory on time and on budget. So that's why the valuation is down a lot. But you think then that people are getting paid a reasonable dividend to wait for the management team to bring this mine online?
Yeah, B2, I mean, that's one of their calling cards. They've always had high dividends because they've always had low cost. So they're a high dividend play. They're over 5%, their dividend, and they've always been in that area. But I think one of the reasons B2 went down is their largest mine is in Mali. And when they did that merger, I forgot the name of the company they bought, the one they're building right now, Sabina. When they bought Sabina, the Sabina shareholders did not want to own a company that's mining in West Africa. So their shareholders dumped the stock, and it's never recovered. It's never been able to come back. And the reason why it's never recovered is because what you just said, they're building this very large mine in Nunavut, which isn't an easy place to build mines. And people are expecting runovers, and a delay, in getting the ramp up. So people are nervous about that. But now that mine is more than 50% completed. And I think once that mine goes into production, we're going to get a revaluation of B2. And yeah, I think it looks pretty darn good. As long as you don't mine West Africa, if you don't mine Mali, then it looks pretty darn good at this valuation. If you want
Yeah,
dividends and upside, and I like it.
I think they're pretty good risk reward for one of the mid-tier gold miners out there. So the valuation is a lot lower than it normally is. The market's still worried about if that mine, like you said, can come on time and on budget. In terms of dividend increases, though, it's still relatively early because we've only had this move from the gold price to sub 2,500 up to 2,700 just the last couple months. So you're going to need a couple quarters minimum gold prices to stay there before the miners maybe commit to additional free cash flow investments, maybe in share buybacks or dividends. But with the royalty companies, there's quite a few that have announced dividend increases because their profit margins are safer. So like Royal Gold and Osisko Gold Royalty, and in the small cap one, Vox, I think they've all announced 6% or more dividend increases in the last couple quarters.
Yeah. Yeah, one last thing on B2 Gold, and then we'll move on. I actually have it rated as a major because I have my own definitions, but they have a $4.5 billion market cap. So they're not a small company. They're one of the largest mid-tiers, if you want to call them a mid-tier. 4.5 billion plus they're going to get re-rated higher once they get this mine built. So they're a pretty big company.
And the other points about Newmont that we didn't talk about is we have to put their costs in perspective. Don mentioned the 2 quarters in a row of their cost creeping way higher than the market expected. Well, Newmont's costs, I think in 2020 or 2021 were around $1,100 an ounce. And here we are, their all-in sustaining cost in 4 years is up to $1,600 an ounce. So that's a very, very large increase. So yes, the gold price has risen. Yes, they do have substantial free cash flow, but I think like the average, it's not necessarily the gold industry, Don. I think it's like the generalist investor. So if you're like a pension fund or an institutional investor and you're seeing the cost rise like that, you're kind of worried because like they're kind of debating which where they can allocate capital to in the gold sector, and it's just easy for a portfolio manager on Wall Street to buy like GDX or Newmont Mining.
Yeah, let's. I want to switch now to Montage. They had a news release today about their financing, and this is right up your alley, Jason, because they funded this through a streaming deal, 2 streaming deals, and this is, I think, the play here to go buy Wheaton after this deal. So Montage, it's $900 million capex, and they raised 825 million, and 700 million of it was streaming, and that streaming is going to get paid out at a 20% spot. So it's 20% spot they're paying today would be $540 an ounce. And so every
That's
ounce
over $2,000 an ounce margin.
it's huge. It's insane. I mean, I want to go buy Wheaton after watching this. It's not a small deal. We're talking $700 million. And so for the next 5 years, these royalty companies, I mean, Wheaton is just going to be, if gold goes to $3,500, my goodness, there's a little bit of, I mean, I can't, basically Montage couldn't get a bank to give them a loan. And what they were telling me at Beaver Creek was they had like 8 banks that were ready to give them loans. And they said there was one private equity company that was going to give them $400 million. Just a private equity, here's $400 million, pay me back over 5 years. Well, all those deals fell through the cracks, which is crazy. That tells you we're at $2,700 gold, and the bank still won't give loans. They only got $125 million in loans. And listen to this: the $125 million in loans, neither came from a bank. One came from Wheaton, and the other came from Xinjiang Mining.
Which is one of the larger Chinese. Yeah, they're one of the larger Chinese mining companies.
So the banks would not give them a loan, which is insane. And so they had to basically do $700 million in streams. So
they're in Africa, right? So this miner, for our listeners out there, this junior that you're talking about, they're in Africa. So a lot of these banks, if you're a large US or large European bank, there's like bylaws in there. So a lot of these banks now, Don, are ESG. So they don't want to go invest in fossil fuel investments like oil, natural gas, coal companies. But they also do not want to invest in a lot of mining companies too. Rick Roll talked about this yesterday on an interview. He said that like Basel III, one of the banking regulations that was hidden in there was that the banks, a lot of them can't do certain types of mining financing. But that's opened up opportunity for Wheaton, like you said.
Huge. Yeah. Yeah. The other thing that we're learning from this deal. Well, first thing we're learning is that the banks are not, right now they don't really care about mining in Africa, that is. So we're going to see probably Chinese companies going into Africa because China has no problem investing in Africa. So we're probably going to see more of that. The other thing is the big companies, they can kind of self-fund themselves, or they can get loans. Again, now Montage is a development company, But a company like Endeavor Mining or Perseus Mining, they have a good balance sheet and they have assets, so they could get a loan. But these new developer plays or exploration plays, they could have trouble raising money. But the one thing I wanted to say about this deal is that Montage is going to lose money on 23% of production. So they got 20% goes to Wheaton at 20% of spot, and another 3% goes to Zinjan at 20% of spot. And then if gold goes over 2000, there's a bit of a sweetener where Wheaton will give Montage a little bit of money, not very much, above the 20%, but it doesn't get to 25%. It's maybe 22%, 23% a spot. It's just a little sweetener. It's like
Is that 2,500 or what number did you say for that for Wiener changing?
2,700.
Oh,
If
2,700.
if
Okay.
gold goes above 2,700, Wheaton will give them a little bit of a sweetener above the 20% mark, but it's not very much.
Maybe they need
And
to
I,
restructure that deal eventually. But I mean, like, if you want to talk free cash flow, like silver, not silver Wheaton anymore, Wheaton Precious Metals, like the free cash flow that they have at these gold prices and these silver prices, absolutely insane. So they can do a deal like that for $800 million, and the free cash flow is going to come back very, very quickly to reinvest into other deals.
it's it's insane how much because I think gold is going to go to $4,000. So Wheaton, over the next
Well,
5 years, just this deal, this one deal alone is just they're gonna have a boatload of free cash flow.
you want to talk about another hidden optionality in Wheaton Precious Metals? They also have platinum and palladium streams on Platreef, which is going to be the world's largest and highest cost, world's largest, highest grade and lowest cost, sorry, mine, platinum and palladium mine in South Africa. Most of the mine's going to be optimized. They're building it now. So phase 2 is supposed to be done with construction by the end of next year. And it looks like there's potentially going to be some type of sanctions on Russia, platinum and palladium, and there was already supply issues. So if we start to get those huge spikes in platinum and palladium that a lot of commodities experts have been predicting over the next couple of years, Wheaton Precious Metals will have platinum and palladium streams on the best margins for highest grade, lowest cost platinum and palladium mine coming online by the end of next year.
Yeah, I'll give people a little nugget so they can go look at. So there's a company called Stillwater Critical Minerals. It's not Sibanye, it's not Sibanye Stillwater. It's a separate company, Stillwater Critical Minerals. They have 3 million ounces of platinum, but they also have palladium in Montana, and their in situ value is $8 billion, and they were valued at their market cap was like $15 million a couple of weeks ago. Now it's bounced a little bit. I think now it's over 20, but it's still around $25 million. But I mean, if you look at the share, if you look at the chart on it, it's starting to bounce. But you talk about, platinum and palladium. This company has a lot in the ground, and their valuation is peanuts. I don't own it, but I have FOMO, so you guys can go check out the website, Stillwater Critical Minerals.
Do they have a feasibility study? So are they going to be raising capital in the next 12, 18, 24 months to try build a mine, or they're not that far along?
No, they're just an exploration company. Glencore has 15% investment. They have plenty of cash to drill with. They do not have a PEA. They just have a resource estimate. They don't plan to do a PEA. They're just drilling. So they basically not
Okay.
have no
Okay, so
plan.
it's not like Platreef. Platreef is literally like, I think they've put in billions of dollars already. Ivanhoe has into that mine. They have like a Japanese large multinational company, Japanese companies co-investors. I think the Rothschild family also has, the banking family has a huge investment into that mine as well in the different stages. Platreef. I mean, by the end of next year, phase 2 might be online for Platreef phase 2. I mean, that's going to be, according to projections, highest grade, lowest cost platinum mine, one of the top best ones in the world, end of 2025.
I only bring it up because there are very few platinum and palladium mines in safe jurisdiction. This mine is in Montana.
Yeah,
So
yeah, that's the issue. For some strange reason, Don, all the platinum and palladium in the world, it's in some of the 3 unsafest countries.
yeah,
It's in
yeah.
Russia, and then it's in South Africa and across the border in
I
Zimbabwe. And
can't
those are
Yeah, I had not even heard of this company. I was shocked when I looked at the market cap and I looked at the chart. I'm going, this is ridiculously cheap. So you guys can take a look at it.
So now I want to transition to near-term producers. So are we at a gold price right now, Don, where you think we're going to see some of these smaller producers or mid-tier, they can easily go out and say raise hundreds of millions of dollars without selling a lot of streams, without drastically destroying the share dilution and go and build a new gold mine in the next couple of years? Are we there yet or not?
Yeah, we're definitely there where the gold price is at 2,700. We're yeah, I think we're there where companies are going to start to get a little more aggressive towards development. So a couple of examples would be Spanish Mountain. So Spanish Mountain has basically been in hibernation mode for 10 years, literally doing nothing for 10 years. They just did a raise and now they're moving that project forward. Heliostar and the Ana Paula mine and some of their mines down in Mexico they acquired from Argonaut. Argonaut wasn't, they're going to let those mines die, but now at $2,700 gold, Heliostar is like, yeah, let's go put these back in production, drill. So some of these projects that were marginal, say at 2,300, 2,700, they're very profitable. 1911 gold, that was another one that was in hibernation. Now they're moving that one forward. So it's starting to go forward. But a company like one thing we are seeing is that gold in the ground remains really cheap. Like Banyan Gold, $8 an ounce in the ground, and it's just still sitting there. And so we're at the very beginning of it. But once we get, it's really going to pick up speed. I have like 50 companies that are on my optionality list that kind of fit into this category of a lot of gold or a lot of silver in the ground with no value. Like no, it's
Does
like it's
Banyan have a feasibility study or are they just drilling some exploration drilling?
they're a pure exploration play. They have a PEA, but no PFS. I don't believe. But they just want to drill and sell. But but the point is that they're getting no value right now. It's like nobody's interested in building it yet. Um, but they're just one. I just mentioned them. There's several companies that are kind of in that boat that are super cheap anywhere from gold in the ground, $20 or less. You have Free Gold Ventures is an example, Tudor Gold, and so Collective Mining. You have a lot of these companies that have a lot of gold in the ground, and they're not getting any value. So in the silver space, you got Kootenay. They're not getting any Southern Silver. I mean, these companies are valued at like 25 cents an ounce in the ground, which is insane. And so I think that is going to flip and go forward here soon. And I think I've always said the key is $35 silver. And I posted this chart twice on Twitter showing if you look at the monthly chart in silver, after silver went to $49 last time, it came down below 35. And then over the next 6 months, it went back and retraced 35 six times, but it never got above it. And it was just a candle. It was just a wick. It never closed above 35, but it wicked above it 6 months after that 49 move. And so for me, 35 is like the key level. Once we get above 35, I think that's when the M&A all kicks in, both in gold and silver. And we start seeing some of these mines getting built. A good example is Corani. Bear Creek, it's a really large, low-grade silver mine down in Peru, and it's construction ready. And I've always said, once you get above $35 silver, I think the banks will give them a loan. But below 35, I don't think they will. And Bear Creek is starting to move at 32, 33. It's going to rip at 35, I believe.
That's very interesting. Yeah, I remember many years ago, Wheaton Precious Metals, when they were just silver Wheaton, they had tried to buy a silver stream on Corani, and then they had to restructure it. So there were some issues there. That mine has a lot of base metals, though. There's been a lot of mergers and acquisitions in the silver space, Don. Do you think that some of these silver companies are they overpaying?
No, nobody's overpaying. No. We've not seen in silver, we haven't seen anybody overpay. So we've seen two mergers recently. We saw Gatos and First Majestic. That was a merger, very low premium, like 18%. And then we saw Silvercrest get taken out by Coeur, and they paid a little higher. I forget what it was on that one. Um, but they neither were high premiums. So nobody's paying up for silver right now. But I do think we're going to see a ton of mergers and acquisitions in the silver space. I think Avino is going to be the first one to go because they just don't have any institutional ownership. They're very vulnerable. They don't have high insiders. They have no institutional money. Well, 80% is retail. So I think Avino goes first, and then we're going to see some more deals though. Go Gold worries me a little bit. Vizsla, I'm hoping those because they have beautiful projects. I hope those don't get taken out. Even Endeavor Silver is another one I think is vulnerable. Those three. I don't think anybody will be able to take over Aya. I think Aya's should be safe because they have enough insider holding, and Boumadine is such a beautiful project. But I do think we're going to see a bunch of deals, especially like some of these exploration plays in silver, like Minorum, Black Rock, and Suma. Those three to me are all kind of low-hanging fruit for some of the bigger mid-tier producers to go after. I think Black Rock will be one of the first to go. Suma's a little early. Minorum's ready. But yeah, we're going to see a bunch of deals in the next 12 to 24 months.
Now, do you monitor what the, say, Orion Mine Finance or the precious metal royalty and streaming companies, what juniors they're investing into? Because Orion, for our listeners out there, they're like a private equity company. They tend to hit on almost all of their deals. So if they're buying, let's say, into a developer or a company that has a feasibility study and Orion provides capital, the mine gets built, Orion tends to make a lot of returns on their investments. Are you monitoring where these companies are investing into which juniors?
Um, no, the one thing about those investments is they generally do not make the news wire. So I don't get it. So I only learn about those investments generally. Like Eric Sprott, when he does a deal, those get announced. But it's pretty rare for when Orion does a deal, theirs will get announced. So it's a bit of under the covers. It's hard for me.
Oh, because they're not
Like,
publicly traded? Yeah, I don't think Orion's publicly traded, so I don't think they have to make press releases and announcements.
boom, you nailed it. That's exactly it. Yep.
Yeah,
So
so
they
they can stay under the radar. So for our listeners out there, you're looking, Orion provides financing for a lot of these. So I'll give our listeners an example of one. They're in South Africa for the Blyvoor mine, which used to be a large mine. Right now, it's a tiny little mine, and so Orion's providing capital, I think, for an expansion there to massively increase production. I think they're only producing about 30 or 40,000 ounces of gold a year, but now they're going to plan, I think, to up to way over 100, maybe 120 to 150,000. So Orion Mine Finance is providing the capital to restart mining up to a higher scale now.
right.
Yeah, so that's what Orion does, but they don't have to announce it. So, but I guess if you check juniors and you check to see where the capital is being allocated, if they're getting like some of these investments from Wheaton Precious Metals or Franco-Nevada, I think Franco-Nevada and Osisko Gold Royalty, they just did one of the largest syndication deals. Normally, you don't see those types of deals. I think there's only one or two other deals the last 10 years where two larger precious metal royalty and streaming companies co-invested into a deal.
Yeah, so let's talk a little about silver. So silver got above $33 on Friday, which I think is really a significant level, and I think people are really interested in what silver's doing, and as far as the mining sector. So it took a long time to get back above $30. So we had a 4-year hiatus, right? 4-year correction, and then silver finally got above that 30 level, and it back in May, and it ripped all the way to 32.50. I thought it would go all the way to 35, but it didn't. And then it came back down all the way. I think it had a 26 handle. So all summer long, silver was basically in a correction mode. And then we finally broke out above 30, and we've been above 30 for I don't know exactly how many weeks we've been above 30, but we've been above 30 for quite a while. And then on Friday we had a big move. I forget what the percentage was, but it was fairly significant. I think it was more than double digits on Friday, and we got to 33.63, I believe, on Friday. And everybody was saying that this is it. we're off to the races. Silver has broken out now. Basically, the equivalent of March of this year for gold, when gold went from 2070 and it broke out and just raced to 2300. It really hasn't. Gold really hasn't looked back since that breakout at 2070. And a lot of people were equating Friday's move to that move. But I was like, whoa, 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 we got to get above 35 and hold it before we get excited. And then it went to $34 on Monday, and everybody was like, see, Don, we're breaking out. And I'm like, no, slow down here, slow down. Because we have the election coming up in 2 weeks. And my thought is, we're not going to get above 35 before the election. And after today's price action, silver's back down to 33.69, so it's off about $1 from where it got to. It almost got to 35, but it didn't. And gold has been somewhat volatile this week. It's been up over 26.50, and then it's been making big $20 moves, $20, $30 moves up, and then $20, $30 moves down, which is what I kind of expected to happen prior to the election, volatility. And now the markets, the S&P, it's at 5809, knocked on the door 5900, didn't quite get there. So basically, I'm very bullish. I think we're going to end the year very strong in gold and silver. I think silver is going to get over $40 by the end of December. So I'm expecting a big rally in silver by the end of the year, and a big rally, not as big a rally in gold. I don't know if we'll get to 2,800 by end of the year.
Now, you mentioned $35 an ounce silver being a key point there, and how in the past it bounced off of it. I would argue the industry, when they're replacing the produced silver reserves, when they start bringing on new mine supply, the industry is going to be looking, saying that we need silver to stay above $35 an ounce going forward for some of these potential new silver projects, whether that's a Pizzeria mine in Mexico or others. There's a lot of other silver mines that could be brought online, Don, in the next 5 to 7 years. But really, sub 30 silver, they're just not economic, probably even sub 35 silver. So we're going to need $35 an ounce silver as a price floor just to replace the production we already have at some point in the not too distant future.
Yeah, I agree with you 100%. My feeling is that you need $35 silver for the industry to be healthy. And that's kind of what you're saying. Healthy is basically replacing these mines.
Well, all the new mines, a lot of them were found in the last cycle, say like 2011, 12, 13, but they didn't bring those mines online because they need a higher silver price, and then the silver price was in a bear market for so long. So basically, those mines need 35 or higher silver to bring those online. So like Pizzeria was one, Silver Standard owned it. I think there's hundreds of millions of ounces of silver. The one in Argentina, La Navidad, but that one has political issues, so that one's not economics.
I would say right now the industry is about $19, $20 ASIC. And I think we could,
I think it's higher. I think if you add in all the costs, I think it's closer to 25 to 28 for a lot of the producers.
I agree. That's the reported ASIC that they'll give us. Let's say use 20 as a round number. So if 20 is the ASIC, the break even is about 26.
Ouch.
So, right. So if it's a 26, they want an area, a room for mistakes. So they don't really want to build a mine at 30. If the silver price is 30, they're only making their margins $4. It's about a 10% margin. Well, a 10% margin is not going to cut it. You really need at least 15% margin to be, comfortable. And ideally you want to have 20 to 30% margins. Once you get to 35% margins, you're very happy. 10% margin or less is not good enough. So you're right. $30 silver. I think $30 silver is the floor right now. If we go below 30, I think it won't stay there very long. That's why I think the floor for gold is either 2,300 or 2,400. We're going to find out here in November how low it goes, but I think it might be as high as 2,400, which is pretty healthy. I mean, that gives most of these companies, Newmont, they're like 1,900, 1,950 for their basically break even. So $700. Most of these companies are $800,000-$900,000 margins at 2,700. They're doing fine. So the gold industry is healthy right now, as long as 2,700 holds. And I think not only do I think it will hold, I think it will trend higher. My target, I moved my target up for gold to be 4,000. We're not going to get to 4,000 next year, of course, but I think we're going to get to 3,200 next year. I think that's a conservative number. So you get to 3,200 next year, and if gold remains strong, there's no reason why it can't rip much higher than 3,200 in 26.
Are there any low cost silver deposits that you said would have the high profit margins that say have a feasibility study and that you think some of the diversified miners that haven't done acquisitions, so Pan American Silver or Hecla haven't done major acquisitions in the last couple of years because they did acquisitions a few years ago that maybe would be targeted in the next 6, 12, 18 months that you think are feasibility study maybe close to getting bank financing if silver prices stay at these levels or go higher?
Yeah, there's three, but I don't think any of them are for sale. The first one is Vizsla. Vizsla came out with a PEA with a capex of $225 million to produce 20 million ounces a year. It was insane. The NAV on it is at current silver prices, what is $1.5 billion. And the ASIC is under 10. The other one is Go Gold, their Los Ricos project. It's not quite as sweet as Vizsla's, but it's pretty darn close. Their capex for Los Ricos South is about 125 million, and then Los Ricos North is about 200 million. So they're not super high cost. Plus, they'll be able to afford Los Ricos North from the cash flow from Los Ricos South. But I don't know if Vizsla or Go Gold for sale. So they both have low cost mines. Adriatic, but they're just building their mine right now. That's another one that I think could get taken out as Adriatic. They're ramping up in Q1, Q2 of next year. Their ASIC is below $10. And then the other one is Aya in Morocco. Their Boumadine project is going to have low cost, but I don't know if that one's for sale either. So all these low cost silver projects, they're just not for sale.
Well,
So
unless someone comes in and overpays. So unless like let's say Pan American Silver or one of the other larger miners says we're going to pay a really high premium and we're going to buy out all the warrants for the senior management at the junior mining company that are out of the
right.
money.
But the problem is the upside on these companies is so huge that it wouldn't really matter what the premium is, if you know what I mean. It just
Well,
because
it depends if the CEO of the junior miner wants to go lie on a beach somewhere. Because I mean, I've heard of deals
exactly.
done. I'm sure you've heard of this too. Like the Yamana Gold deal, the Yamana CEO really didn't have any reasons to sell. I mean, now in hindsight, like why did he sell at that time? Why didn't he just wait another year or two? So from what I heard, he just wanted to cash out.
Absolutely. We see these deals that don't make sense all the time. But from a shareholder standpoint, the only thing that makes sense for Gold or Vizsla to sell would be something that's fairly accretive to shareholders, where the company that's buying them also has big upside, so the shareholders don't get, obliterated. I actually think that Gold and Vizsla should merge as a merger of equals. It'd be a perfect situation. There was a company, Mandalay Resources, that basically doesn't have a pipeline. They have zero pipeline. They have 50 million in cash, but they have 50% insiders. So if they can get their cash up to and they're generating free cash flow, if they can get their cash up to 100 million, and then they could protect some of these companies because of their insiders. So that's where I think Avino, they did a merger with Mandalay, then a merger of equals, then their shareholders would be protected. Nobody could take them out. So you could either do a merger of equals, or you could do a merger with a company that has high shareholders, high insiders, that basically is buying your company for the upside, and then you're not for sale. I'd like to see a deal like that.
Well, we'll see
But
what happens. I mean, the history of the industry for a lot of mergers and acquisitions is not good. The industry has a history of overpaying for a lot of deals. The mines, when they get built, don't come in on time and on budget. And the worst thing, Don, as you know, is when they overpay with equity dilution and then they do a reverse stock split. And some of these mining companies, the larger ones or mid-tier ones, they have a history of these things.
right, we haven't seen anybody overpay recently. I mean, Ken Ross overpaid for Great Bear, but that was a long time ago.
Well, I would argue, Don, that like now a net present value with the pre-feasibility out, I'm not so sure because I think like they would have no chance at that bid. I mean, Royal Gold bought the royalty for Great Bear for 150 million cash. I mean, with the pre-feasibility out, that there's no way that royalty is worth way more than that in the current market, probably worth hundreds of millions of dollars, at least double that amount now. So we're
Right.
in a like a when you start projecting cash flows, and even if you discount the cash flows down to 2,300 gold, I mean that royalty on that mine
And
with that
tell me, right, go ahead.
I was gonna say like a net present value like that. You get very little now for 100 million bucks, 80 to 100 million bucks for a royalty. So like for that type of like long term royalty on that quality mine, 150 million, people are not gonna care when that mine cash flows.
Right now, I think that right now, gold in the ground for like pure exploration plays only going for about $35 an ounce. And development projects are going, depending on how advanced it is, like Osisko mining was very advanced, but maybe double that, $60 an ounce. But so we're in a climate right now where it's a buyer's market. If you can get somebody to sell their project, even at a 50% premium, it's total buyer's market. But after we do a few M&A cycles, and all these companies get valued higher and higher and higher, then we'll start to see overpaying. So I remember back in the from 2005 to 2007 area, and then all the way up to 2011, we were seeing some overpaying where people were paying as much as $200 an ounce for exploration, just for gold in the ground, like 1 gram. I think it was 2 grams. Uh, Open pit gold mine at 2 grams, which is a very high grade, they are paying $200 an ounce. So
How much
and
above the normal amount is that?
it's about, well, 1 gram was going, maybe at that time, maybe 120. It wasn't double, maybe $125 an ounce. But I think right now, so we're about not even a third of the way to where we're going, if you will, as far as valuations in the ground. Because we've had poor sentiment for 10 years in the miners, and we haven't really had a cycle where, an M&A cycle where everybody was trying to, find project and, buying. And so
Well, there wasn't capital available, so they couldn't do it.
yeah, yeah, exactly. There's no capital available. Plus, their share price would get, butchered if they did a deal. I mean, look at Newmont when they bought Newcrest. They got butchered, and so nobody wants to do a deal. B2 Gold, they got hit hard when they acquired Sabina.
Equinox too. Equinox shares were down 80, 90%, something like that for Greenstone.
Yeah.
So they're going to start to recover as Greenstone gets close to commercial nameplate production capacity. I think they're around 80% right
I,
now as of the last press release. But as that mine gets to 100%, the
I,
shares will recover there too.
yeah, so I think gold's going, somewhere between 3,500 and 4,000 this cycle over the next 2 to 3 years. And so I think that gold in the ground is going to be worth, $100 to $200 an ounce. And right now it's about 35. So these companies have a ways to go. And yeah, we're going to see some reflation here with these projects. Like right now, Newmont trading at $10 free cash flow. I think they're going to be valued somewhat before this cycle is done, 25 to 30, before this cycle is done. So you're basically buying Newmont, I believe, today at half off. You're getting a 50% discount at $49, in my opinion.
And also, in my opinion, Don, I think that Kinross, there's no way they would have won a bidding war had that Great Bear mine gone to pre-feasibility. I mean, because there were rumors out there that Newmont Mining and Bear Gold and some of the other larger players were waiting for that junior to get to pre-feasibility stages or PEA and all those things, and then Kinross would have had zero chance to win a bidding war.
Yeah, yeah. In hindsight, I don't think they overpaid that much, but at the time, it appeared that they did. And so everybody thought they did. But you're right. In hindsight, I mean, it's a 10 million. It looks like it's a 10 million ounce mine. At the time, we didn't know how big it was going to be, but the resource they basically
The
paid up.
gamble looks like it paid off. Yeah.
Yeah, it looked at the time. We didn't know how big the resource was going to be. So Kinross they gambled that it was going to be as big as it turned out to be. I actually thought it was a good deal for Kinross. Now we're going to see what Kinross pays for Free Gold Ventures, which is, their Fort Knox mine is right next to Free Gold Ventures. And Fort Knox is done in 2030. So all they have to do is move their mill 15 miles away and move their manpower and all their equipment. It's like easy peasy for them. So it's going to be really interesting to see if someone bids against Kinross, because it's absolutely a perfect situation for Kinross if they can get their hands on that mine.
Now, you've said this is a buyer's market for mergers and acquisitions. Do you think that that's why Newmont Mining hasn't been able to sell off some of the assets that they've been telling the market that were going to sell off and get cash for much earlier this year? I think they've been saying for almost 12 months now that they would be selling a lot of their tier two
Yeah.
assets.
Yeah, that's funny. So, yeah, Newmont they're basically, they bought these assets from Newcrest and like they're really cheap. And so they go to sell them and they go, man, how come nobody will pay anything for these things? Yeah, I agree.
Well,
I think
they have other
that
producing
situation.
mines too that they've screwed up on. I mean, Rick Roll, if you talk to Rick Roll, and I've had off the record conversations and interviews with Rick about this, I mean, Rick is adamant that the Eleanor mine in Quebec, which is producing, I think the costs are like 1,300 or 1,400. Rick has said that if a mid-tier gold miner bought Eleanor and optimized the mine, reinvested in it properly, because he said basically that Newmont, once they decided it wasn't going to have 10 million ounces and it wasn't an easy mine to run, that they didn't want to put much capital back into it. He said that if someone ran it better, he thought that the cost could come down and they could expand the reserves and expand the mill. So that's a mine to look at and see which maybe mid-tier miner would go in and buy that from Newmont for pennies and go and fix that mine. It sounds like there's a lot of potential there. Rick said he had visited that property, so that's one to keep an eye on.
Yeah, I think that's exactly what's happening to Newmont is the going rate for, these companies is about half what it should be. And Newmont is trying to get top dollar, and this is not a good environment to be selling mines.
Well, that's unfortunate for them because they're telling the market one thing and then it's not happening. So they're telling the market they're going to have cash to go and fix their balance sheet, right? That they were going to sell those assets that are quote unquote tier two, even though for a mid tier gold miner, they'd be great. So if you're a mid tier gold miner out there and you're looking for a pretty good project in Canada, it's already producing, you put more capital into Eleanor, maybe you can get the cost down and you could expand the reserves. That's an acquisition to target. I don't know what price Newmont's willing to sell it at, but that's a potential thing there. Newmont, it sounds to me like they don't want to sell it at the valuation the market wants.
Yeah, well, as long as gold prices trend higher, they don't have a balance sheet problem. They're going to be generating a lot of free cash flow at Newmont. So
Well, as long as their costs don't keep rising, but yes, their cash flows will go up, but so will their costs. Unfortunately, we're seeing this stupid trend, and now it's like worrying the generalist investors, which is why, as a royalty company investor, just I've owned Wheaton Precious Metals since it was below $15 a share or below. So I've been just buying and holding it and collecting dividends on it. So I think long term, that's a pretty safe strategy. I know you can make like hundreds of percent returns on your shares, but you're taking a lot more risk than me.
right. Well, you're going to make baggers on wheat, and I think it's going to go up at least 3x. So it's going to do better than a lot of the majors. It'll do better than Newmont, I believe.
Oh, for sure. I mean, like they have those platinum and palladium streams coming online at the end of next year. So if the U.S. Washington D.C. does really dumb stuff with the Russia sanctions, or the LBMA does and blocks supply of platinum and palladium from Russia, we're going to get a huge spike in those metals prices.
Right. Absolutely.
So
Uh,
let's talk about the macro situation here as we wrap up, Don. And thank you so much for all that analysis there. Probably my listeners are going to have to go back and listen to some of the other company names quite a bit because you mentioned a lot of them. What do you think of the macro situation right now? Do you think that like all these central banks and governments that they have a pro-inflation policy lately?
I don't think that people realize how much trouble the U.S. is in economically. I don't think people realize it. I think a lot of people are nervous about where the U.S. is going forward here, but I've been analyzing this macro market pretty much nonstop, especially like full time for the last 5 years. But I've been doing it 20 plus years, watching the U.S. economy degrade, if you will. And what happened was the US economy basically peaked in the late 1990s, where it could basically grow on its own, where we didn't need the government, the Fed or the Treasury to stimulate and manage the economy. But that ended in 1999 when the dot-com bubble busted, and then we had 9/11 in 2001. And since 2001 forward, I could make an argument 2000 forward, U.S. economy has literally been relying on debt. So we've been printing GDP. We've been printing growth. We've been living off of debt. So now it's just living off of a credit card. You can only do it as long as your credit is working. And I believe that at a certain point, you run out of credit. And I think the US economy is pretty much there. I think we are there. I think the Fed is out of moves, if you will. So they made this 50 basis point cut, and Wall Street thinks, oh, it's not a problem. They're just going to keep cutting, and the economy is going to come roaring back to life. But the problem with that is that the US consumer, which is 70% of the market, is basically broke. 50%, more than 50% of households right now cannot afford their budgets. They're basically trying to figure out what to take out of their budget every month. And it's getting worse and worse. And we're seeing it in the retail level, where a lot of these retail outlets are basically saying, that we're losing our customers. And it's getting tight out there. It's getting problematic out there. We're seeing a lot of retail stores close, seeing a lot of restaurants close, and retail's a problem. The dependence, like China was dependent on their construction industry for their growth, and now they have a problem with construction, and their growth is, I think, flat to going down. The U.S. is dependent on their consumer, which is basically going in the wrong direction. And so growth is going to go flat to going down. And so that's been building. And then on top of that, you've had the federal government's balance sheet. So the federal balance sheet this year, we had over $1 trillion in interest payments, which is higher than our spending on military, which is kind of insane. And the deficit's around $1.9 trillion, and they can't stop spending. And that money is the only reason why GDP is positive. And so if we had a $500 billion deficit, which would still be large, we would have zero growth in this country, approximately. So growth is, we're literally printing growth through our debt.
Well, that's nominal growth. So it's not real growth. And then the government is growing because a lot of the jobs that have claimed to have been created, in the last 12 months, I would say a lot of them are actually government jobs, or they're healthcare related, which are kind of pseudo government jobs.
Yeah, yes, healthcare is subsidized by the government, so it is pseudo government jobs. Government workers, the last non-farm payroll had the highest increase in government workers, say before we had the COVID issues ever. It was totally manipulated data. We know that wasn't true. They manipulated it to make in the non-farm payrolls look positive heading into the election. It was a total manipulation job. And like I said, the economy is very weak, I believe. I believe it will not take much. And I talk about, we're going to go into a soft landing. And I think that's pie in the sky fantasy. I don't think we can avoid a recession here. And so we can't avoid a recession. Think about how much leverage is in the system, and think about how much debt is in the system, and think about what the Fed uses generally to restart our economy. They restart it by lowering rates significantly and then injecting money.
Liquidity,
Well,
yeah. Some
both
type
of
of
those,
like spending program. Yeah. I don't know if it's like infrastructure, or like maybe it's to subsidize consumer spending with lower credit card interest rates or auto loans, or I mean, they've been bailing out student loan debt. We don't know the real number. The
right,
Supreme Court was supposed to block it. As far as I know, the estimates I've seen, they spent already $170 billion minimum on
right.
student loan debt bailouts. But I mean, like, if you listen to some of the speeches from Biden and some of his like higher ups there in the administration, it sounds like they've moved budget money around, Don, from other programs into old programs that are 50 years old or more. And there's way more than 170 billion in student loan debt bailouts given out. So we don't know the real number.
Right. And my point is that both of those create more inflation. So rate cuts actually create inflation, and then more spending causes more inflation. Plus, I think that banks are going to require a lot of bailouts. I was listening to Andy Schectman, and he said, I haven't found a link to it yet, but um, on Tuesday, he said that there was a bank that failed and there was a bail-in that basically the FDIC did not give the customers of the bank 100% on their deposits. They're only going to get 250,000. They didn't make them whole. They did not make the customers whole. That's what Andy Schectman said. So if
Interesting.
if that if that becomes a trend, the whole banking system will weaken.
Well, did you see that the FDIC also owns, like, when Signature Bank, they couldn't sell off some of the commercial real estate portfolio that Signature Bank owned in New York City. So the FDIC actually got stuck with owning like office buildings and some rent controlled apartments. So I don't know if they sold it yet, but I mean, like, they were making phone calls around trying to sell it for pennies on the dollar. No one wanted to buy this stuff.
Right. And commercial real estate, you make a good point there. Commercial real estate is a big problem for this country right now. Where like in Los Angeles, like last I read, 50% of the commercial real estate in the office space in downtown LA was empty. It's kind of insane. And I know that San Francisco, I think, is even worse. And
It's
so,
20-30% average, I think, in most cities and metro areas. So yeah, you said the high end. I mean, it might be higher in San Francisco or Los Angeles or some other areas, but the average is about 20 to 30%. I think there was an article in the Pittsburgh, their main paper, and I think they were doing, like, unofficially, that they had reporters going around trying to track the numbers, and they had the number at about 50% of the office buildings downtown were unoccupied in downtown Pittsburgh, which is,
and
shocking.
that, right. And that's going to roll into losses. Someone's going to have to eat those losses.
Or bailouts, yeah. Someone has a
And-
bailout, some type of bailout scheme, some type of
right.
new bailout scheme. They
That's
created,
a crisis in the making, which nobody really talks about. Because
or Washington D.C. sees it as a jobs program. There, they create a new government agency instead of Fannie Mae or Freddie Mac.
that's
They create a RuPaul
that's
Mac, like a they create like a cross-dressing pro ESG, pro woke government agency and stick the garbage in there and hire a bunch of ESG DEI hires there and give them $80,000 a year higher government jobs.
but as we know, that's inflationary. That's not a free lunch.
Yep. Yep.
And
Yeah.
so
It's a jobs program like the Soviet Union. Yeah.
and so yeah, so if you look at the path forward, it's not a pretty situation. Wall Street is talking their book, trying to get us to believe that the economy is in good shape. It is not in good shape, and we don't see it turning positive. As a matter of fact, I think things are trending negatively. I mean, if we look at employment's been trading. Unemployment was at 3.4, I think was the bottom, and now we're at 4. Well, it went down a little bit, but I think that last month, because I think that non-farm payrolls was a bunch of baloney. It was at 4.2. I think it went down to back to 4. But it's been trending up. I think by first quarter, I think we're going to be, say above 5% is my guess. And we're basically, I think the recession's, I think, going to start here in Q4 after this election. That's my gut feeling. My gut feeling is that this market is done, if you will. And
Well,
it took all the way until they started cutting rates. It's like once they start cutting rates, because the reason why is because we had this expectation that once they start cutting rates, everything's going to be good. But it's going to be the actual opposite. It's going to be a sell the news event.
I've heard for the last 12 to 18 months that with, like, the programs that they did with the FHB and the BTFP program that was for, like, the bank liquidity programs after Silicon Valley Bank, that the goal was just to keep the stock market elevated in the US economy from being in an official recession until after this presidential election. And then I heard whoever was in the White House 2025, it was going to be an absolute mess and that there was going to have to be bailouts planned for regional banks and commercial real estate and the insurance companies. I mean, like, and that's even before the hurricane. I mean, like, I don't know if you've seen some of the data on the insurance companies in North Carolina and Florida. They're going to your
God,
state legislature, Don, and they're saying that they need to raise premiums in those areas by 40%. I mean, like in this environment where people are struggling to pay their bills and all of a sudden they get hit with a higher, insurance cost, that's just nuts.
Yeah, so I'm another guest that's confirming that outlook that 25 is going to be a mess and we're going to need a lot of bailouts or it's going to be a hard landing. I'm totally confirming that. That's exactly my thought.
Well,
There's no way,
well,
the only path forward here is down.
Well, I heard in 2025 that this has been the plan for over 12 months that they needed to juice the markets and keep the banks propped up and the stock market propped up until after the November election here in
Right,
2024. And then
yes,
by 2025, they realized that basically like commercial real estate and the banks and
yes.
all the holders of the bad commercial real estate loans, that's insurance companies too, and pension funds are in such a mess that they're going to have to start doing bailouts. That's what I've heard. So
Yeah, yes, I do believe that's the case, and I think the whole point was to make sure that Trump loses. They had to keep everything stable and keep the stock market up to not give a reason to vote for Trump.
yeah, I mean, we'll see what's happening. I mean, according to the polling, but that's rational. So we know like there's tons of games and stuff like that. So I don't know what's going to happen in the election or not. I mean, if there's going to be crazy amounts of election rigging or whatever, I don't have any control over this. I just, hear things from different sources here in Washington, D.C. metro area, but things are pretty dire beneath the surface for a lot of the real economy, like you said, especially with commercial real estate. I mean, nothing's really improving. They can't refinance all of their loans. And the most important thing, Don, for commercial real estate is cash flow. So you don't have small businesses that are willing to pay higher rent. In fact, a lot of these
Yeah.
businesses are closing locations. Look at all the announcements for
Yeah.
restaurant and retail. They're all like downsizing now.
I made that point earlier. I do want to say something about the election. So my thought is, you can call me an election denier, but I just thought that 2020 was, I just thought that there was so much irregularities with that election. It was bizarre. I mean, the fact that they stopped counting at 3 a.m. across the country, it's like, what? Who made that phone call? I mean, because I don't think that was in effect before the night began. That they basically, I don't remember that news release where they said, if we don't have a winner by 3 a.m., we're going to stop counting, right? That was bizarre. Then the other thing was bizarre is that it was a close election. It was a close election, but the mainstream media, they just called everybody election deniers. It's like, well, do an audit on those counts and make sure they were valid, right? We
Well,
didn't have.
the mainstream media and the government does that all the time. So anyone that disagrees with them, you're a conspiracy theorist. But then,
Yeah,
like it seems lately, Don, the last quite a few years, 35 years, a lot of the conspiracy theories out there that people said,
that
"Oh,
turned out to be true.
yeah, yeah," they turn out to be a conspiracy fact. So all the
Exactly.
tinfoil hat people are being a lot of the stuff being proven true. It's
Almost across the board. I tweeted yesterday, there was a guy from Australia, elected official. He was in Russia. And he basically gave a press conference and he was talking about COVID, the vaccine, how it was dangerous and how he's being muffled in Australia. And yeah, that's one of those conspiracy factors that's turned out to be true. It was basically man-made. And if it was man-made, I think it was purposely released. And then the vaccines were all created before they were ready to go before COVID came out. The
Well,
whole
big
thing
pharma
smells
was in
like heaven.
financial trouble. Like I don't know, like there was articles. Do you remember there was articles before the pandemic about big pharma had a patent cliff, and a
Yeah.
lot of these big pharma companies, also Boeing, their balance sheets were loaded with debt from share buybacks, and they had like big pharma had a ton of drugs coming off patent, especially like Pfizer and some of the other ones. So they were in financial trouble. So is Boeing. Hey, Boeing's in financial trouble, needs a bailout. Oh, look, the Ukraine war keeps going on, and Boeing keeps making more war profits.
Yeah.
Shocker.
It Right. So that election's it just smelled to high heaven to me. And they didn't put that. Then here's the kind of the clincher is they didn't put anything in place to make it different from 2020 to this one. We still have the ability, anybody has the ability to go to one of these drop-off boxes and just stuff as many ballots in there as they want. There's nobody standing there to prevent, anybody to drop off. And we have videos. I don't know if you've seen them, but we have videos from 2020 where people are taking crates of ballots, these drop-off boxes, and it's taken them minutes to stuff them all in. Now, where in the hell they get these ballots from?
Well, I mean, the counting also closed in certain areas for hours too, which is there was a ton of irregularities and a lot of
Uh,
other stuff. I don't want to
uh,
go into all the details here, but there was a lot of red flags there. The mainstream media is denying it. The election was, I think it was stolen. There wasn't, the Supreme Court didn't apparently want to deal with it too much either, unfortunately. This is the United States like is so corrupt in so many different industries now, Don. We could probably spend hours. We've talked for over an hour. I want to thank you so much for your time today. I can hear my dogs barking, so I don't want the audio to get destroyed in the background there. If
no
my
problem.
listeners want to check out gold stock data, how do they do so?
Yeah, if you already own a few gold and silver mining stocks and you want to expand your portfolio, then you can use my site for finding stuff because that's what my database does is 850 gold and silver miners, goldstockdata.com. And you can follow me on Twitter. Just search for Don Durrett. And Jason, thanks for having me on.